Morning, everyone. Right. Welcome to our morning webinar. Right. We first of all we do apologize for the hiccup that happened on Monday. So as promised, we have scheduled the webinar to this morning. But we do note that future webinars will still be carried on as usual on Monday morning. Right. So. Right. So for today's agenda, we will mainly be giving some updates on some of the companies under our research coverage and followed by a more in-depth outlook on chip and sync. Right. First is on the update of LentroVision, which has recently announced its full year fiscal 2014 results. For the quarter, quarterly revenue gained 20% year-on-year at about 14 million. That was attributable to more installation projects in Malaysia, China, and the Philippines. For the full year, revenue was reported at about 152 million. That's represents about close to 14% gain year-on-year, and mainly due to more installation projects. Quarterly earnings have gained about 30% year-on-year, and one key thing to note is that the operating margin for the fiscal year 2014 is significantly improved from 9.1% in the previous year to currently about 11.8%. So that has resulted to a higher full year earnings at about 14 million, which is about 52% higher year-on-year. Right. Also, dividends has final dividends has been declared at 3 cents per share, which is higher than the 2 cents which was given out in the last fiscal year. So, assuming that this is maintained for the next fiscal year, that will imply roughly about potential dividend of 4.7% on based on current pricing, right? So as of current, the payout is about 58% of its earnings, and hence in our view we do think that there may be further upsides to the increase in the payout, right? Key industry growth drivers that will drive the business of LentroVision will be coming mainly from the increasing trend of cloud computing, which will lead to more storage, as well as the increasing demand for data centers, especially in the Asia Pacific region. Also, there's also a trend of upgrading of existing data centers to be more cost efficient, as well as realizing higher energy savings from it. So that also lead to more business opportunities for LentroVision. And also the fourth driver will also be coming from an Internet of Things phenomenon, whereby we are seeing more integration of building management systems, such as the heating, ventilation, as well as air conditioning applications, which traditionally have always been on a standalone basis. We are now seeing that they are getting more connected to IT systems, and we may see that's in a smart office environment where one can actually control the air conditioning system from mobile devices. So the management is still seeing such a trend in their recent installation project works. Right. Key competitive strengths of LentroVision is mainly its excellent 23-year track record, global presence with its Lentro Global Alliance partnership, as well as a diversified top-tier client base. Right. And we still continue to have a positive outlook while we remaining cautious on cost pressures that may arise from the tight labor market. We are maintaining our accumulate rating with a revised target price of 72 cents. Right. In our view, that is still considered cheap, as the forward P represents roughly about 4P of about 7.8 times excluding cash. Right. Next, right, I'll hand over to my colleague to give an update on Valuetronics.
Thanks, Colin. Okay, here's a update from Valuetronics. Actually, this was for last week, but anyway, so essentially this is the first quarter results. all in all, revenue did increase slightly to 626 Hong Kong million dollars. Okay, so yeah, we have basically low single-digit growth for revenue, gross profit, and net profit. Okay, very minor-ish, slightly flattish growth. Okay, but for Valuetronics, what's going on now is it's basically a tale of two cities, right? It has two segments, the CE and the ICE. So what's I guess interesting to note, very significant, is that the CE revenue, okay, has slowed down faster than expected. Now, obviously, we noted in our research that the LED market is in a expansionary phase right now. Right now, it's expansionary. The market is supposed to be growing at double digits, okay, while price decrease. Okay, so although the price for LED is supposed to decrease, but volumes are supposed to compensate for this, but this did not happen for Valuetronics. So this casts some earning uncertainty for the CE going on this year. We have to monitor to see what happens next quarter to see whether this is something systemic or is it or the degree of how systemic this problem is. Okay, so the slowdown is faster than expected. That is not good. However, at the same time, the ICE revenue is really surging. It has done much better than expected. I was forecasting optimistically high single-digit growth for ICE revenue, but as you can see, right, it's on track to grow. This quarter grew year-on-year 30% plus. So it's on track to have double-digit growth this year. So even though the CE segment was the slowdown was higher than expected, but the ICE revenue is also larger than expected. So now you've got the tale of two cities. Okay, so how do you see going forward? Now, there are challenges going forward. Okay, but this has been going on for quite a while. There is still some uncertainty in the broader China economy. And there is more price erosion due to competition. So the CE revenue has dropped primarily because even though the market is expanding, there has been more competition, hence hence the slowdown in sales. So the risk would be, will Valuetronics client, how will they tweak their strategies to compete with the new competition, to whether they can to see whether they can stabilize the revenues for CE. So that would be an uncertainty and a risk. However, at the same time, Valuetronics' strategy of transitioning to have more ICE customers, which is what they are focused on, because ICE, if you remember, has higher margins than CE. So by design, they do want to transition to ICE. So far, their aggressive marketing strategies have been very successful. So a positive would be they recently added a new customer already in the first quarter of 15, and we have not actually seen revenue contribution from them this quarter. You will start to see it next quarter and after that. Hence, there's a strong case that there will still be continued growth in the ICE revenue. I'm talking about quarter-on-quarter growth. So next quarter could be higher than this quarter. So there you have it. So you have ICE, which is expected to grow even more, but LED might be slowing down faster than expected. So all in all, you end up to have very flattish single-digit growth, 1.8%. So how do we see it now? Well, even though there's a bit more uncertainty right now, we don't know how much more ICE will be successful. Neither at this point in time we have to see how the CE slowdown will affect things for the year. But at the same time, Valuetronics does remain inexpensive at 6.5 times PE. Now this is based on the price of 51 cents, right? Price today is, I think, is 48.5 right now. Okay, so that's roughly 6.5 times trading PE, x 60% net cash. Okay, so it still has strong free cash flow generation, and it supports a yield of more than 6%. So that does compensate somewhat for the earnings volatility, as I mentioned in the report. However, we are still reducing to an accumulate rating. Rationale is because since initiation, Valuetronics has returned up to 60% to clients, and so now the share price a lot higher than initiation. There's still some upside going on, but we just reduce the accumulation because the upside is a lot less now. Okay, and yep. So there we have it. That's the story for Valuetronics. I'll now pass you to our next analyst, who will update us on Pan United.
declines. Pan United's results were a little mixed, good and bad. Revenue actually declined 1%, almost 1% year on year for the second quarter. But as you can see, the core profit numbers of EBITDA, EBIT, PATMI all actually advanced. So what happened? Overall, revenue decreased because revenue for the basic building materials segment declined due to ongoing structural challenge in the Singapore construction industry, which we actually highlighted in the first quarter of this year. These structural challenges are tight labor market and regulated working hours, which are resulting in a lower output. Now, contractors are unable to find productivity gains, so that means overall they can't make up for that lower output, and with lower output means lower demand for ready-mix concrete, which is the principal product being sold by the basic building materials segment, which also led to softer selling prices. This proved to be the main drag on revenue, because actually revenue for the ports and logistics business advanced 18% year on year, as the new port CCIP, which is adjacent to CXP, was integrated in a better than expected fashion. So with the ports exhibiting higher utilization rate, especially at CCIP, I think because these are much higher margin segments compared to the basic building materials, we had EBITDA and EBIT margins advance to 13% and 9.9%, which are the highest in recent memory by a couple of percentage points. As debt is pared down over time, actually the margin expansion will flow through to the bottom line as interest payments decrease. In any case, we had to reduce the target price from 133 to 119 because the slowdown in the Singapore construction industry looks structural to us, and it's something we might have to live with for quite a few more quarters until some kind of productivity gains are found by contractors. It's quite disappointing because the demand for construction is actually still at very high levels due to the amount of public works that is being done in Singapore. However, contractors are unable to keep up and capitalize on this. Overall, we've had to reduce the target price to 1.19 and reduce our estimates. Okay, Baostat Singapore. The first quarter results, also there was a revenue decline, 1.17% year on year. This was due to the real estate solutions. However, energy and geospatial advanced. So for energy, the surge in the advance in core profitability from 4.2 to 5, 5 million profit before tax was a 19% advance due to the surge in energy contracts, which continues. Shale boom and capex cycle is returning for refiners. Okay, geospatial advanced 4%, and Australia, Singapore, and Indonesia exhibited stronger usage, and so year-on-year profits there increased by 32.7%. Now, as we said, real estate was the segment which had an 11% drop. This is because I think there's increased competition in full turnkey project managers, and that is the challenge down there. However, similar to the Pan United story, the overall effect is that core profit again has advanced for Baostat. So as you can see, EBITDA, EBIT have all increased by 30%. Operating EBIT has increased by almost 30%, right? And this was mainly driven by energy, geospatial, and a greater contribution from the industrial property portfolio. Okay, so actually the only segment that isn't doing that well right now is the full turnkey project management. Okay, the other segments are doing very well. Now, the overall PATMI declined by 9%, but this was only because year on year there was a much larger exceptional item last year as compared to this year. Okay, so the overall effect was a decline in PATMI. However, core earnings-wise, we have about a 30% advance. Bowsted's undervaluation is exhibited by this table over here. It's not the method that I use to derive my target price, which is based on a discounted cash flow to equity and a 20% discount on that final valuation, actually, to reflect a conglomerate discount. But this table here is interesting because it shows you on a sum of the parts basis what Bowsted is actually worth. So taking the earnings from energy, design and build, geospatial, and these are our forecast earnings for the year, and multiplying them by peer averages of PE, right? Taking the industrial property portfolio, final size, right, and using a 7% cap rate on it, get the value there, and taking in the values of its stakes in Somerset, 111 Somerset, Beijing Tongzhou perennial mixed development, both of which are perennial holdings properties, managed properties, right, and you get a final value of 1.5 billion, and you add in the cash and financial assets net of debt, you get the sum of the parts of 1.7 and a fair value of 3.34. So as you can see, actually at the current price of 1.8, Bowsted is pretty much trading at a significant discount to its true value. And with that, I will pass you on to Yong Kai, who will talk about our top call, Chip Eng Seng. Oh, sorry, we actually accidentally skipped OCBC, so let me just go back to that, and then we'll go on to Chip Eng Seng.
Very good morning to everyone. Benjamin here. Okay, if you guys have been tracking, quite big news last Monday when I brought it up was the rights issue by OCBC. So this will give you a little bit more take on it after we had a more detailed briefing on last Monday afternoon. So just take note that the share price of 10.40 is actually last Friday's closing price. So today is about 10.04 after it went ex-rights on Monday. Right, so OCBC announced a 1-for-8 rights issue on the 18th of August. Okay, the rights shares, by now I think you guys should know that it's priced at 25% discount to 10.20. So that brings us to $7.65 for each rights shares. The total equity that's raised by OCBC is about 3.4 B, so it's about 10% of their current market cap, close to 10%. Right, so it's roughly within our previous expectations. So previously, when they announced that they were going to acquire Wing Hang Bank, we expected them to raise at least 2 billion of equity, right, through some capital exercise. Right, so currently, what we think is that 25% to 10.20, right, should be very, very attractive to all the current shareholders to subscribe for the rights issue. Right, so currently now is a subscription period has opened up. Right, so we expect some minor dilution of 3% to 2015 EPS after the rights issue and after we have consolidated Wing Hang Bank into OCBC's books. Right, looking on the capital ratio side, which is precisely the reason why they had to do a rights issue, right, the fully phased-in common equity tier 1 ratio, okay, of 10.2% on a pro forma basis was still shaved by about 110 basis points previously, pre-consolidation and pre-pro forma. So previously, before we account for Wing Hang Bank, the fully loaded is I think 11.3%. Right, so after we consolidate Wing Hang Bank, right, on a pro forma basis, till 2019 fully phased in, it drops to 10.2%. Right, so I think we can continue to expect capital management, right, as OCBC will probably try to bring this fully phased in CET1 ratio closer to DBS and UOB. Right, so what I mean by this is I think we can expect continuous scrip dividend schemes going forward. for the next few years, right, at least till 2019. Okay, so management, what we think is management still has a very, very long way, right, to prove to us on the merits of this current acquisition, right, because previously our take was also that OCBC is really paying a very big premium for a Hong Kong bank that's mid-sized and is focused on retail and SME banking, whereas OCBC's own penetration to China is targeted towards large corporates. So this really is a bit disparate between OCBC's their own core banking business as well as Wing Hang Bank. Right, so the acquisition of this, I think management really needs to take some time to prove to us, right, on the synergies that will arrive and come out of this acquisition, right. So therefore, our take is still neutral on OCBC, and our target price is still unchanged from previously at 10.20. Right. So with this, I hand it on to Yong Kai to talk about Chip Eng Sing.
Hi everyone, this is Yong Kai here. So on about 2 weeks ago, I published a report on a trading buy on Chip Eng Sing, stating that it was at 83 cents is really quite deeply undervalued. So today I'll just slightly elaborate on what I've written in the report. Okay, so quick snapshots. As of last Friday, it closed at 89.5 cents. Today is roughly 90 cents. It's on the highest of the 52-week range. Market cap is about 570 mil, and RNAV is a much higher 930 mil. So it has 4 segments. Construction has about $550 million order book and earned $25 million. Okay, and one thing we want to highlight is that Alexandria Central, the strata retail, which it started selling at the start of last year, this component will TOP in 4th quarter 2014. So we expect it to book around $152 million of profits. There is some unsold residences, 9 residences and Fulcrum, but the break-even cost is around 20% below current ASP, average selling price. So we don't really see much risk of impairments. And also Australia, it has quite a big land bank. It owns Tower Melbourne, which is almost fully sold out, and it still has a land bank to build about more than 1,000 residences. Noteworthy is that it has previously built in and sold in Australia before. This Tower Melbourne is actually its 3rd property, so it's not a newcomer. When you add up all the development surplus and value gains, you'll be looking at 82% boost to NAV, and it's paid out about 4 cents annual dividend in the last 4 years. So construction arm, we are not going to spend too much time on this because it's roughly 10%, it roughly contributes 10% of the RNAV. So a very back of the envelope way of valuing it is to use the order book. We should use the 4 other peers, which are either pure plays or close to it, because many construction firms like Lian Beng, Looking What, they also have property developments. So if you use a blended valuation based on the order book and you apply it to Chip Eng Sing, this segment could be worth $160 million. But bear in mind that this valuation doesn't take into account profitability. So as of now, we noted that CES construction arm actually earns near a 6% pre-tax margin, which is comparable to Soy Builds and actually much higher than the other 3 peers that I've identified here. For property portfolio overview, there aren't many of them, so it's easy to just quickly gloss through them. With Alexandria Central, which we acquired which won in the state tender in late 2012 and launched the strata retail component in early 2013, and this is the one that actually garnered investors' attention. This 99 years leasehold property is currently under construction, and it also has a 450-room 4-star hotel that will be managed by Park Hotel Group. So based on what the data we have, according to URA release and the project cost, we figure that the retail components at 65% efficiency should see after-tax profit of $152 million. Okay, as for the hotel component, Alexandria area is pretty untested, but previously what we understand is that CES was offered $820,000 per key per hotel room. No current plans to divest, so if we just use this figure, it could be higher if the hotel performs well, but for now we just use this figure, and we will be looking at a reval surplus of $109 million. Just for perspective, every $100,000 increment to the per key of hotel valuation will add about 7 cents to Chip Eng Sing's RNAV. For Junction 9, it's at Yishun, so it's also currently under construction. The strata retail is almost sold out, whereas the 186 unit condominium is 77% sold, which is pretty good in today's context, given the market sentiments. So again, looking at this, the total cost that we worked out and the ASP that we have seen in the URA release. So the after-tax profit from the sold units will be $39 million, and when the other 23% of the condominium is sold, this number could increase much higher. Belvedere DBSS, in fact, this quarter they are going to TOP, so we expect the after-tax profits to be around $30 million and lump sum recognition upon TOP. Okay. Lastly, for Fulcrum. Fulcrum is the last residence they have. Is 18% sold. So, given the numbers, right, at this 1,657 PSF break even, we don't really think that it needs to write down. For perspective, the line at Tanjong Rhu, which is also uncompleted, sells for much higher, $2,246 per square feet average selling price. Whereas the freehold condo, which was completed more than 20 years ago and much bigger, more than 2,000 square feet units, all of them are more than 2,000 square feet units, fetch $1,373 per square feet. Whereas for Fulcrum, their average unit size is about 900 per square feet, so they can fetch much higher selling prices, PSF. CSS Center is an investment property, so they only left 54 years leases, 54-year lease left, and primarily they intend to use it as a CS office. Okay, what this office is, it is 12 stories. They intend to occupy 2 stories of it, and the remaining 10 they'll be leasing it out. Currently, it's 100% vacated while they undergo A&A works. They're going to spend about $20 million on it. So in the near term, we don't see any redevelopments, although in the medium to long term, we could be maybe developed into a hotel or mixed developments, and given its prime location, which is 10 minutes walk away from Chinatown MRT, we think that this should be considered as a land bank and worth substantially more in the future. Australia Properties, again, as we mentioned, so Tower Melbourne is its 3rd residential property that's launched in Australia. It's 99% sold, pending demolition works. Okay, so for all these Australia land bank properties, we are not really factoring in any development profits or reval surplus, because the first contribution for Tower Melbourne will only be expected in 2018. So that's more than 4 years down the road, and there's quite a fair bit of uncertainty. And such we choose, and because we don't have much information on it, so we choose to just rather carry this at cost. So all in, Alexandra Central, Junction 9 project, Belvedere DBSS and Fulcrum will contribute about $364 million of profits and reval surplus, and this has not factored in more contracted sales of Junction 9 Fulcrum. Okay, just a note of Fulcrum. The location is actually pretty good. It's going to be located, it's actually at the doorstep of one of the upcoming MRT Thomson East Coast line. So we don't really see any write-downs necessary. In any case, what previously we worked out is that if the project requires an impairment of $100 per square feet, this will only translate to $7 million loss, pre-tax losses, which is actually digestible for CES, which has more than 500 mil market cap. Next, Fernvale Condo recently is won at a state tender. Again, they haven't released any plans yet, but if there's encouraging sales or average selling price, this would be another positive. Also, Tower Melbourne, Australia launches, since it has more than 1,000 residential units that can be launched. So this is another something that to look out for. Lastly, the redevelopment and the full leasing of all 10 unoccupied floors when A&A works are completed. So company valuation, okay, we just want to quickly highlight the management owns 30%, appears to be shareholder friendly. They paid out a 4-cent dividend since 2010. The recurring income from the Park Hotel, Australian investment property, as well as CES Center works out to about $16.2 million, which is 2.5 cents EPS. So in the near term, we expect this 4-cent dividend to be sustainable, buffered by the development profits of average $90 million till 2016. Okay, regarding the capital from the Alexandra Central Strata Retail, CES actually indicated that they will probably be keeping most of the profits, and we speculate that they'll be recycled into the Fernvale project given the high capital cost. Next, you want to look at 2010 and 2011. They also combined profits in the 2 years was a spectacular near $300 million, but they also didn't declare any special dividends during those years. So special dividends, if any, upon Alexandria Central Strata Retail TOP might not be a very significant. Given all this above, we think that using a 30% discount to RNAV ought to be sufficient, if not conservative, to derive our target price. So this is our RNAV, $984 million versus the market cap of $568 million. CS today trades at around 0.61 times RNAV. So if you think, okay, what we think is that 0.7 times is more appropriate. So even at 30% discount, you're looking at 15.1% upside, and this is excluding any special dividends, any dividends or special dividends. Okay, on that note, because all this while we've been talking about the Alexandria Central Strata Retail TOP, we want to highlight to you that that is a potential catalyst, but that might not be the end game. So just a case study, you look at Oxley Holdings. First quarter in 2014, they also recognized quite a fair bit of net profit lump sum. So this figure was 20% market cap, 100% increased NAV, yet the share price barely moved for the 1 month. So yes, while we think that Alexandria Central Strata Retail TOP is a possible share price catalyst, but don't bet on it, on the share price moving immediately on the fourth quarter results, because it might have been priced in, or people might just take some time to digest it. So even in the case of Oxley, even though the share price barely moved above 50 cents after that earnings release, the share price still eventually rallied to achieve 57% returns. Today is at around near 70 cents. Okay, with that, we'll open the floor to Q&A. Welcome for questions. Thank you.
Hello, sorry, this is Caroline. There's a question on OSIM. Why is there such a sudden drop today? It seems that the issuance of the bond does not warrant such a large drop in price. We believe that the market actually reacts negatively to the news because since that, as you know, OSIM, they are a strong net generating business model, and also that they are having strong net cash position. So somehow the market do not expect actually such. Why are they actually issuing this bond with that? So we believe that's the reason why the market actually reacted negatively when it's open today. But if you look at it right now, it actually recovers accordingly, and we believe that for this, because the company should have some acquisition plans in place, though details are actually not disclosed at the moment. So this is why we feel that actually just the market reaction to this, because it doesn't seem to warrant why is that so. So they think that they might have some like behind stories about it. But from what we understand, is actually the company is actually planning for some acquisitions, though the details the company has not actually disclosed anything on it. Thanks.
Hi, Benjamin here. Give some comments on Sembcorp Marine. Where the previous analyst has left, so currently we are still undergoing a change for this. So as of the last report, our last rated report, Sembcorp Marine, our call is still neutral, right? But this might be revised going forward after the transition is fully in. But just to give some comments, currently Sembcorp Marine's year-to-date order book is about 12.7 B, right? Quite above the market consensus for the amount of order wins this year, where about 60% of their current order wins is actually on drill ships. Right, so I think going forward, at least on a more macro view-wise, it seems to us that for this year and next year, there could be quite a bit of a oversupply of standard jackups that we are seeing in the market. Right, but you can see that for Sembcorp, they're gradually shifting towards building drill ships, which are used more of for the ultra deep water portion, especially from the Petrobras orders. Right, so I think going forward, I think we might be expecting to see more of drill ship orders coming into Sembcorp Marine instead of semi-subs and jackups. Right. Whereas for the jackup side, I think we can look at more towards Keppel for that portion because of their world-class design of the Keppel B-class K-Fells designed for the jackups is more of a premium jackup compared to those that are coming out from the China yards. So most of the oil majors are looking towards using more of this type of premium jackups instead of the standard ones. Right. So roughly this was our comments on Sembcorp. Thanks. I have a question on target price of 1020. I believe that relates to OCBC. Our valuation is actually for the end till the end of FY14. So currently for the valuation of 1020 is actually on OCBC's books itself. So that's pre-consolidation of Wing Hang Bank. But 1020 is not much higher than last month's share price. I believe that right before the announcement of the rights issue, it actually went up to about 1040. Yeah. Thanks.
Hello, there's a question on actually the target price for Thai beverages and also a question whether we cover supergroup. Sorry, but we do not cover this both. For Thai beverages, the actually based on the market consensus is about 70 cents or so. Thanks.
Hi, Kenneth here. Question is, what is the macro situation? The US market hit a new high. Is the correction over? Okay. First of all, on a fundamental basis, the economic situation is actually doing well. Okay. Most recent data has been pretty positive. Okay. That being said, there is an interplay of technicals because for the technicals, what I see is that it is possible for short term to go up, to drift higher. But if I'm a trader, I'll put a tight stop because I do see certain weakness in breadth. Okay, so the thing is, the move is higher. It is still bullish. Macro situation is good. Sentiment seems to be good as well. But at the same time, you have confirmation in terms of breadth for new advance and declines, but you do not have confirmation for sensitive markets like the Russell or the Nasdaq. Just like to say that for the Nasdaq, even though Nasdaq has been going higher, right, breadth-wise, it actually has not. Apple, which has been doing well, right, is kind of pushing up the Nasdaq. but the rest of the Nasdaq in itself, right, is actually not as bullish. So how I read this is that, okay, so we got good macro, good sentiment, and new highs, but at the same time not supported by breadth. So it's likely that for the short term it can still drift higher, but I would probably put a tight stop if you choose to go. So going long is probably correct, but you need to put a tight stop if you are trading. Okay, so hope that answers the question.
We have a question on Chim Ming Sing. What is the cash flow like going forward given the projects they have on hand? Okay, so as you said that the profits rise, right, they'll be recognizing quite a fair bit from the recurring income as well as the development profits. Okay, regarding cash flow, we are going to receive quite a fair bit given the milestone payments as well as the TOP of Alexandra Strata Retail, Belvedere DBSS, etc. So they are going to be pretty cash rich, which they are going to recycle into the Fernvale project, where their land cost itself will cost about $290 million. Hope that helps. Thank you.
Hello, there's a question on the target price for OSIM. If you look at my latest report, the latest target price we have is about 3.15 or so. Considering that the bonds, which is the principal amount is about 170 mil with an up option on another 30 mil, which let's say if we pull it to full 200 million or so, and the exercise price is about 3.525, we expect there's a dilution of about 7% if it's fully converted in the 5 years time, and the target price might be bring down to about 2.93. This is just a very rough estimation also, which still give about more than 5%, which is about 7 to 8% upside accordingly. Thanks.
Hi, this is Richard speaking. There's a question asking for comments on SI Engineering. So we initiated on SI Engineering a few weeks ago, about 2 weeks ago. Currently, we have an accumulate rating target price of 492. Well, for the outlook for SI Engineering, so SI Engineering we think that SI Engineering is the best proxy for exposure to travel growth in the Asia Pacific region and also for Singapore. So that's why we are still optimistic on it. And also, we see that although the passenger numbers arriving at Changi year on year has declined, but we think that this going forward it should improve. And also in the last quarter, some of the headwinds was caused by the political instability in Thailand. And if you refer to our Thailand reports in Poems, there's a report from for Airports of Thailand. The outlook coming from the Thailand side is that they think that the passenger numbers have bottomed out as well, and they're expecting strong growth in passenger numbers for the following quarter. So I think that the region is currently now recovering from the slower growth in the last 2 quarters in passenger numbers. Yep. Hi, are there any more questions?
Hello. That's actually a question on have we seen the bottom for Wilmar? For right now, I can't say that we have seen the bottom or it's going to bottom out or is it going to fall further. I think it will actually move more sideways because for now there's a few actually headwinds to this Wilmar business. Firstly, the price for CPO, as you know, is actually more on the downside considering the huge amount of oil is coming up in the third quarter or so. Secondly, also the refinery margins for the their palm and laurics are still under very challenging conditions. For right now, we don't see actually a significant improvement in the refinery margins too. Although for the performance on their oil-seeds crushing has improved in the second quarter as compared to the first quarter. From what we understand, the conditions in China for the oil-seeds crushing business is still I would say tough in this sense. So for right now, for sugar, though we expect to see the improvements from the second half of the year due to the seasonal factor, but overall on the whole, we do not really see a very bullish catalyst for this counter yet. Thanks.
Hi, this is Richard again. There's a question on SIA Engineering about any issue of shortage of labor. Currently, this issue hasn't been flagged for SIA EC, but we'd highlight that SIA EC also operates their base maintenance in the Philippines. So actually, they just opened their third hangar in around June this year. So what's going on for SIEC is that they're having this, instead of being totally reliant on the Singapore base for doing their heavy maintenance, they now have this option of doing some of the maintenance in the Philippines as well, which is the labor cost there is also lower than in Singapore. There's a question of when to buy SIA Engineering. So our current rating is accumulate, and there's with a 1 year horizon for 492.
For Bausted, there's also a question on is it a good time to buy it. I think it's an all right time. I can't say if there's going to be a Kenneth thinks that maybe there might be a market correction. Maybe you might get it at a better price. But I'm pretty sure that if you buy it now at high 170s, low 180s, you're still getting a good deal, and that eventually the price will go higher. Thanks. Thanks for your participation. We'll be back right on schedule on Monday again, and we'll be extra vigilant that there will be no more technical hiccups. Thank you.